Previously in early June, when the market kind of went really strong, it was that Russell and Dow Jones catch-up trade that made us go kind of mini parabolic, so to speak. And then we had a few weeks of relative weakness throughout the rest of June, heading into July. This go around, it seems like instead of a catch-up trade occurring in these small caps and cyclical, dollar sensitive cyclical areas, instead we're seeing the Qs themselves kind of go parabolic. So the question is this the last hurrah and push? How much longer can we go? What signs are we going to see that suggest that that this parabolic move is over? I'm going to break all that down in today's video and talk about what to expect going forward, and then take a look at a trade idea in that tech space from a stock that that hadn't been participating and it's doing its own catch-up trade. Talk about how to trade that. So let's go ahead and get started. Today is Wednesday, August the 26th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see the rally we've been getting here. It's been a sharp rally to the upside in this near-term run. In fact, on Friday I talked about this concept of, well, here, let me bring this back down to Friday's high point. So on Friday we talked about, okay, you have this, what is it, 280 point drop, 285 point drop from 0 to 23. That represents the risk. Right, and so on new bullish trades from here, the reward to justify that risk has got to be obviously more than 285 points, and usually double that if you're trying to do directional opportunities. So so the idea being here, because we're so far up above support, because we're on such a strong intermediate run and have been for a while. Since then, now of course we have gone from 33.99 up to 34.78. So we've gone up. This to kind of consider the move. This has been a strong move for this week so far on the S&P 500, and it's been, what is that? 78 points essentially. Essentially 78 points, 79 points to the upside, which again is not close yet to what the risk was. 285 points. To the downside, down to 31.14. Because remember, we can go from 0 to 23 very quickly. And now you activate this. Activate this drawing here. Activate these Fibonacci lines, and we say, okay, well now after today, now from 0 to 23% is 34.81 down to here. You're over 300 points to the downside. That's how much risk there is. Because again, as I mentioned, as you've seen many times at the end, especially these long intermediate runs, right? If I were to go back over the last 5 years, where we've actually had multiple, this was a 4-month long intermediate rally. This was a pretty decent intermediate rally, about 4.5 months. This one was our 5-monther, the intermediate rally that ended. And you can see the drops from these intermediate rallies get down to 23% very quickly. That was like the longest, and it took 5 days, and you were to 23% just like that. And of course the near term, the 30-day moving average here, to kind of give you an idea of if and when we do fall, because you will at some point. The question is obviously when. But if we were to fall down there, 31.7682. From today, then you'll see you see that 30-day moving average today is at 33.1304, and you're talking a near over 4% move to the downside, and that would be the beginnings of an intermediate pullback, where the green line works its way below 50. You can see it's going to take a few days for that to happen, to get it from high levels down below 50. But in the process of that, dropping from 0 to 23 will go a long way towards doing that. And then you'll be on an intermediate pullback. Now, the question is, will you go much further than that? You can see the 38% level if I were to draw the Bollinger Bands here. And here, let me do this. Let me put on use a log scale here. We don't need to fit in the studies. And then let's get rid of the expiring cone. All right. So you see, okay, well, if I were to activate this and see where the high point is on SPY from that low point down here, let me bring it down to the low point. So it's right there. Okay, so there's our move. So there's your 38% Fibonacci retracement level of this rally, which you see now is sitting right at the point of control on the 1-year chart. So, you know, and again, there's your 23% level, and for us to break that, you'd also have to break the 78% line of this drop that we are now going up above the 100% line on. So there's going to be, and you can see a volume node there up above the point of control that's almost as big as the point of control is. So there's some pretty strong support in this area on that initial drop to the downside, and there's very strong support if we were to make it to the 38, which in my opinion is actually unlikely. I don't think if on any kind of decline that we would get that far to the downside. I think you'll peter out here in this, maybe a little bit below the 23%, but that's about it. So you can see the, you know, we actually closed up above closed just slightly up above the upper bandwidth today. The other thing too that kind of stands out, I mean, you can see it's all strength in the NASDAQ 100. That's where, in fact, we almost ended up with a cluster again here today. But that's where all the strength is. Look at its 38% line. It's actually above its pre-COVID high point. The 50% level is working its way up to show you how strong that is. But on the other side, we are still not able to really extend away from the 78% level. Or the 30-day moving average for that matter. And you can see the intermediate line is actually really close to falling back below the 80th percentile and potentially within a few days below the market sentiment line again. Something similar to that. So, you know, you can see that, you know, we were kind of in a little bit of a catch-up trade on the Russell, and now not so much. It's full on, the Q is going semi-parabolic again on a relative basis, especially compared to the Russell 2000. You can see the relative strength chart is about at its highest point already again. So much for that rotation trade. When we dropped back down to 1.7, we are right back up, and we're right back above the 50-day moving average. And you can see, you know, when you look at the long-term view here, the PPO of the 15-200-day moving average has rolled up, but still unable to really get up above its moving average. So you can see a little bit of the divergence with the falling PPO and the lower highs in the MACD as we push up the higher highs in the relative strength, and that's showing up here in this extended move higher. We'll see if this ends up being a divergent high point by the time all is said and done. Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. You liked our video and you want us to do another one tomorrow. It's a quick way to give us feedback. If you like our videos, let us know. You can do it with one click right there. If you don't like our videos, of course, you don't have to click on anything. And also comment down below on anything that stood out to you. What questions, what comments do you have about what I talked about? What stood out to you from today's video? Share that in the comment section down below. Join our website at marketscholars.com. There's a link popping in there, right top right corner of your screen. Click on that link to subscribe to our site for free. Follow us on Twitter for more content in between the videos from day to day. And join our Market Outlook Facebook group that we've created. Alright, if you're watching this on our blog, is here with this video here, check out other things including our classes over here on the right, our trading rooms coming up, and you can see more of them here with this link, as well as our Market Outlook live video. I got back to doing that again today after taking a couple of days off for family reasons, but today's is posted there, and we checked out some old trades, including the two that we did on Friday and Friday and Monday's Market Outlooks. Continue to manage those trades there. Also, come down here, click on this heart that opens up this new window. Hit that like button there. Come over here, hit this thumbs up icon. Opens up another new tab. Takes you to your Facebook page, and we invite you to click on this like button here. Again, the more you do those two things, it benefits us because it promotes our content to all of our followers because of all the likes these posts have. It benefits you because Facebook and Twitter will promote content in your timelines from the accounts that you engage with the most. So the more you engage with us, the more you'll see all of our content that we produce. All right, let's get back to the charts here. Let's take a look at a full screen version of it. There we go. And I mentioned those divergences. As you can see, I mean, look at the first of all, not a divergence here on the RSI, but you can see the RSI is above 76. The CCI above 200. You know, it's one thing for us to kind of, you know, begin a move with a run up to those really strong levels and then maintain strength going forward. But here we are now, months into this intermediate run, and we're at the highest RSI level that the S&P has had, and its CCI is getting above 200 for the first time this whole rally. Again, you can kind of go back to here and you say, okay, well, we got up to 200 towards the end, and then we diverged with these lower high points here. And then you look at like the MACD and the stochastic indicators here, and you can see, here, let me zoom out so we can see this a little bit better. Let's go out to a couple of years. You can see how we are a lot. This is where you can see the surge, and then we had the strong move higher on IWM, and then we've been kind of gradually still moving upwards on this trend, and still easily above the 8-day moving average. And remember, I mentioned before that, you know, any pullback doesn't begin until you at least break the 8-day moving average. So keep that in mind. As long as you're above the 8-day, you're still doing well, and we're still just continuing higher slowly. Obviously, not at the same pace as what the risk is to the downside, but you're still easily moving higher. And so any threats to this would not emerge at all until you break that 8-day moving average, and especially not really until you break the 17-day moving average. The other thing I wanted to bring up too was this DMI for SPY. Again, one of the strongest levels we've seen on the positive index here, almost up to 40 here. We got up to 40 on this June 8th peak where IWM played that catch-up trade there. But the negative index wasn't nearly so negative back then. So again, very similar to this type of move that we got here at the end of January before we got this divergent high point where we got lower highs in the positive index and higher lows for that matter on the negative with a higher high on the index itself. So whether or not we'll end up with divergences, it does show, you know, again that our ADX is very, very high. It's close to the 40 level, so very mature trend. You also see that too in the trend strength indicators. You know, again, well up above 80, well above 5 on this. There's our strong trend that we had, that we were even much, much stronger on back when we were finishing this bullish move. And then of course the divergent high point didn't even get to moderately strong levels there. So, you know, that's kind of where we're at right now. The red line here, well above the price that we have. So again, that's the risk. That represents the risk here. As you can see, you can drop down the price pretty quickly. So this is the red line is 26 days out. So it's today's close price 26 days later. So that move down here is the risk that we have. And of course, you can also see we're well up above the cloud, and as I showed you on the Bollinger Bands, we are up above the value area, continuing to trade up above the value area. And if you look at the same thing for QQQ, I mean, we are way up above the 1-year value area, and also you can see the breakout above the upper Bollinger Bands, but not on IWM, which is stuck towards the middle, stuck towards this moving average, and unable to get up above its value area and break through and get up above. So that point of control continues to really exert an influence on the small cap index that you're not seeing on anything else because of the breakouts that's already occurred in these major indexes. Even the Dow Jones Industrial Average still really unable to get up to that old COVID high point because it's stuck in its own value area. You can see now the range between the high and the 4-week high and the 4-week low point. It's going to change here in just a few days. The low is going to really move up pretty sharply, almost 10 full points. But as of right now, you're looking at a 27-point move. So well up above 5%, which is the typical kind of stretching point for the 4-week range when you're bullish. We're well beyond that, right around that 7.5%. And you can see because of that, we're well above its own 4-week value area, which is kind of rare. And that shows, and you see how very little volume there is on this move, which shows how tenuous it is to be up here. So it's a great move, and you can see the volume really picked up. In fact, today's volume was kind of some of the bigger volume that we've had here. It's the wrong chart here. Some of the bigger volume that we've had here for a while, for the last couple of days, back up to this 50 million mark. And again, as you saw in that chart, a lot of that volume coming in, at the end of the day. Look how strong the volume is throughout the day and at the end of the day compared to some of these other days, where there was a lot of volume early and a lot of volume late, and that was about it. Not the case for today. So a very strong move, really hot, very high up above its point of control and value area for its 4-week range, which is a lot, obviously a much smaller time frame than what that 1-year chart that we typically look at. You can see the ATR was about average today, so we've kind of hit the low point. We're not getting, we're starting to pick up a little bit in the last few days on the ranges, at least picking up back to at least the average. So we've fallen down to the 1% mark, and most likely we're going to be unable to really break through that without a bounce first, at least a 1.5, if not to 2, which would mean that we're going to start getting 4. And I talked to you about the 8 crossing below the 8-day moving average. Once we start getting 4 and 5 point ranges, and really remember, it's like I've talked to you before about volatility, and you can see the jump in volatility we had today from these low levels. Just to kind of give you an idea, volatility will jump out of nowhere. Like, here's this 2018, at the beginning of 2018, when we had that pullback there. The jump in volatility lasted 2 weeks. Here in June, when we hit that June 8th high point, we had a pretty decent sized jump in volatility there when we fell to the 23% level in a matter of a couple of days. It happened. All that volatility increase happened in a week, and then over the weekend with the open way up here, and then we've been falling down ever since. So as you can see across a lot of these different areas, when you get these intermediate pullbacks, volatility will jump up in a matter of just about a week, and that's it. And usually from these very, very low levels, we're not at very, very low levels, which means the jump in volatility might be a little bit bigger than what we see in some of these spots. So keep that in mind, especially considering how extremely low volatility is and how wide that gap continues to be. In fact, it's actually widening the gap between historical and implied. See, in fact, historical is dropping still, and implied is now rising a little bit. Again, that gap will get reconciled one way or the other, resolved one way or the other, and more either that implied volatility will drop, which is going to have a hard time doing since it's already so low relative to the VXV, and the compression of volatility is really gotten low too. Like this month's range, we started right here on the first day of trading in August. Right here, we've been down ever since. But you can see the range. We haven't had a pop up where we've gone up and come back down like we do most months with those kind of long upper shadows that we get on the monthly chart in volatility. We haven't gotten any long upper shadows here. See all the long upper shadows across the chart. Even over here, see all these long upper shadows that we get. That means sometime during the month we get a jump in volatility, even up to just 15, and we pull back down. That's very typical, as you can obviously see here. Not this month. We started the month and we've been coming down at pretty much ever since with a very, very small range. I wanted to show you to that range there. It's one thing to have a range of 2.75 points that preempted this kind of 3-month, 4-month rally in volatility to the end of the year into the beginning to that COVID low point. Big move in volatility there, much bigger range, going up to 6.25 points from 2.75. But that 2.75 when you're around 12 versus our range right now, which is less than 6 points, and we're around this 23 level. Again, we're getting a pretty decent compression and volatility here. It's similar to the one that we had in November, where the volatility really dropped down. We don't think it is as much of one because the volatility levels are double what they were back then. So we have to keep that in mind, that if we doubled that range of 2.75 points, we're looking at about 5.5 points, and that's where we are right now, right about 5.75 points. So again, that kind of compression, especially with the gaps here in this volatility and the lack of any moves, leads to the potential for this to resolve with a move higher in volatility. And you'll probably end up getting, the first, again, breaking the 8-day moving average is a sign, but getting that first drop of well more than 1%, closer to 2%, like we did there, coming off of that June 8th low point and June 11th, probably won't get that big of a drop. That ended up being about over 5% to the downside, with a bigger than 1 standard deviation gap to the downside by the time we opened up there. So probably not going to get that, but watch for a gap to the downside, watch for a close to the downside, a very strong close. That will be, the sign that, here we are, this is going to be the week that we get the increase in volatility, whether it happens on a Monday or a Tuesday, most likely sometime early in the week, before we get the rest of the week being, that jump in volatility that comes out of nowhere and that drop to the 23% line. Then it'll be a matter of how much more will drop, or probably won't be a whole lot. And then it'll just be a matter after that of how much longer we'll stay down around those areas. All right, so to summarize our technical outlook, the trend is obviously strong. We haven't had the breaks at all yet that would even suggest that we're starting that breakdown, not breakdown, but the pullback, or even just the noisy move down to the 23% retracement level, which would be, in this case, the beginnings of a pullback, because of how high that 30-day moving average is, up above the 23% level. So we haven't seen those signs. We haven't broken the 8-day moving average. We haven't seen a large 1-2% decline in a single day. We haven't had a large a runaway type gap to the downside that would suggest, here we go on this intermediate run where all these gaps in volatility start to shrink again. We haven't seen those yet, but those are the signs you watch for. Until then, you manage risk reward, right? The reward's still there for any upside moves. We know what the risk is, and so we have to say, okay, well, what kind of strategies and trades would allow us to take advantage of? And those are the kind of things we've been looking at in the types of trades, and we'll continue with that. And whether that intermediate run lasts, 5 months, or whether it goes into 6 months, or for that matter, 7 months through the election. We do know there's seasonal volatility ahead, and we know there's a presidential cycle that will offer some uncertainty as well. But how much longer we'll go into that season remains to be seen. And as of right now, we know it's going to be at least a few more days going into next week, and then after that, we'll see. So what do you think? Do you agree with that? Do you disagree with that technical outlook? Comment down below, especially if you disagree, as to why. Like, what are you seeing? What charts or indicators are you looking at that suggest either you're a lot more bullish or a lot more bearish than I am? All right, let's get back to the charts, and let's take a look at how things moved here today. So let's bring up this chart, and let's actually take a look at how things have been going so far this week. Now that we're 3 days into this week, it's been kind of an interesting move. You can see we're at the highs of the week on the Qs, up 3.5% this week. SPY almost up 2.5%. International stocks and commodities all doing really well. Interestingly enough, the dollar is down, and that's helped produce a little bit of a rally here. It has not really pushed up international stocks. A little bit early, but the Qs have really taken off. And then you can see the difference here. After peaking early this week, IWM, and then in retesting that peak earlier this morning, IWM's only up 0.5%. In fact, gold's up higher this week than IWM is, and that puts a little bit in context the type of move that we're getting. But that drop in volatility, that drop in the TLT is a good sign for this 10-year yield and a little bit of a run that this 10-year yield has been getting. We're off of the highs of the day today, and that's what brought the momentum line down. But you've got the beginnings of a new bullish intermediate run on the TNX, which would be a good sign for inflation expectations. Rising inflation expectations are bullish in the stock market, and the more we get that, you can see, just to kind of give you some perspective, if I were to go back out, say like, let's go out 5 years. Probably need to go more than that. Let's go out 10 years, and then let's go to a weekly chart. And then I want to show you the comparison. So, and here, let's take off the left. Nope, let's leave the left axis on, sorry. And see what that does. Alright, so we're going to take off the left axis. Let's do that. Whoops. So we can kind of get them on, and let's do this too. Let's show studies. Get them on the same page, and let's get rid of the colors. Alright, so you can see, for the most part, you've got, here, let's actually put this left axis back on. There we go. For the most part, you've got a rally in the 10-year yield and a rally in stock markets, and then yields fall down here, and that's a pretty up and down and volatile time in stocks. And then yields rally and stocks rally all the way up to this point. Right, nice good rally off of these lows. The S&P breaks out of this sideways action here in July 2016. A little bit of a pullback in the election, but pretty much from that time that the yields took off all the way up to yields peak at the fall of 2018, stocks did pretty well too, all the way up to the fall of 2018. International stocks have started to pull back here. But then you can see from that point on, yields fell in the fourth quarter of 18, and so did the S&P 500. But from that point, the S&P 500 has really taken off, and with the COVID, is back up to, to easily new highs. But not the case with the yields. And yields here, obviously, this high point that we had pre-COVID was much lower than its fall 2018 highs. The S&P was much higher, and then now we're even higher now than we were there, and we're not even close to those highs on the 10-year yield. So very, very significant divergence play here. So, for this S&P, for this stock rally to really hold, we want to see that divergence here reconcile with the yields coming up to where the S&P is, rather than the S&P coming down. And as I've shown you before, the other thing to reconcile is this outperformance here of, let me go back to 1990, or as far back as I can go. This outperformance of the Qs relative to IWM, and you can see in late 2000 we were up 2 times. Qs were 2 times the value of IWM, and it took all the way to the July of 2002 into 2003, and eventually all the way over here before that relationship reconciled itself. And then it's been bullish ever since. Well, now we're back up, and we've gone parabolic here, and the PPO has gotten very high. Just like we saw over here, the PPO would have been very high as well, and we see the mirror of it to the downside. Well, again, there's going to be a mirror to the downside, and that typically means you have both of these, QQQ and IWM, coming down. So two big discrepancies that you see here. Ideally, you want to see the S&P come up to where the yields are, to come up to where the S&P is, and for the QQQ to slowly start to underperform the IWM, because if there's any significant underperformance, they're both falling. But if it were to kind of just slowly hang out in this area and just kind of grind higher, that would allow us to continue to be bullish heading up towards this too, without another sharp peak. And you can see the moves that we've gotten lately have just been tremendously sharp one way and the other, right, to the upside and the downside. You can see the big moves here, up and down. I see on the daily chart, yeah, up and down, and here we are on another move back up, just like that, coming from that August 11th low point. And if I were to come over here, and there's actually the here, let's go back to the asset class comparison and go to, I believe it was August the 12th that we had here up till now. Yeah, August the 12th, you can see where they both gapped up and Qs gapped up higher. Well, now, the Qs are up 10% and IWM is actually negative since August the 12th. So that goes to show this wide discrepancy that's showing up in this move right here, from below 1.7 all the way up to almost 1.9, and the RSI going from a smidgen below 40. We talked about that, just dipping and still below 40, to now all the way back up easily above 60 again. Again, that's last time we got above 60. That was kind of, and we got to these levels. That was kind of a peak that started some relative underperformance in the Qs, and it started this semi-intermediate pullback here that got to the 23% line. Remember, the next one we get that's like this will be an intermediate pullback, because we will be below the 30-day moving average, not like this one that got us down to it instead. From a sector rotation standpoint, if we take a look at the sector rotation here, you can see the strength that we've had, and let me show you that same August the 12th difference from August the 12th going forward to kind of give you an idea. I mean, look at XLK and XLC. I mean, that's the Qs. That's the large mega cap tech names that are continuing to dominate, and to a lesser degree consumer discretionary as well with Amazon, and that's pulled everything else up. And you can see financials are down, utilities, energy is down, real industrials is barely positive, materials is it's about less than half of what the S&P has gained. So it's a wide discrepancy here between especially up here closer to 10%, where the S&P is doubling the S&P, more than doubling the S&P's return, a little bit more than the S&P's return, and everything else really lagging significantly behind during this run. So we've talked about that's the leadership that's going to lead bullish moves higher, and that's the leadership we want to continue to ride while it's up there, kind of picking and choosing other directional opportunities here and there. But again, that kind of discrepancy can't last for too long. Right? You would like to see the bullishness in these cyclical areas come into other cyclical areas, and we're just not seeing that right now. In fact, if I take a look at the 12 grid for the sectors, obviously you have dark green shading and green lines, and look at these moves, especially in XLC. Look at that. I mean, a breakout move to the upside. Energy, utilities, not dark green. Light pink in financials, and you can see a lot closer to moving averages in materials and industrials and healthcare and real estate. It's these are the three areas that are just dominating performance right now, and we're not seeing it bleed into other areas of the economy. So for our trade idea of the day, I want to stay in the tech space, but in the area that's been kind of lagging, that's Oracle. Oracle's been a really laggard. In fact, it produced an oversold cluster. It's one of the rare stocks that produced one of those here lately, especially in the technology space. It brought the intermediate line down well below its market sentiment, and has since popped back up, and you're back above 50, and the market sentiment line's popping back up. You've got three green arrows again here. Let's got three green arrows again with a little bit of a bump in volume here today on this little kind of semi-breakout move, which is getting up above the upper Bollinger Band and above the value area at the same time. And you also see too a nice good bump higher in the DMI after coming off of that cluster. Your DMI is turned back positive, and the ADX is really rising, showing this big, strong, this big trending move potential that's starting. You see also its RSI is eclipsed 60 after dropping below 40. We're back up above 60 and working our way up as well back into the positive territory on the CCI as well. Its trend strength indicator we had lost its strength with this pullback. It's been very, very noisy, but obviously we've popped back up. Nice, good pop back up here to moderately strong levels on both these indicators and well up above the cloud. So you're getting, opportunity for breakout. You can also see too, after getting a golden cross, we pulled back down to the 200-day moving average and bouncing back up with a good, strong bullish candle this week. So an opportunity for a little bit of a directional move. Now, the issue that we have is we have not earnings, but any kind of seasonal volatility. So I don't necessarily want to go out to October with a bullish trade because we do have to, on a vertical spread, especially like this, it's got to stay above, in this case, $62 by expiration. So, but with a smaller time frame, the September expiration, if that volatility occurs after, then we can make a move up towards 62. You can see it's within 1 standard deviation. So buying the $59 call, so right here, which is above where we're at, and then selling the 62 call to offset the price, brings my risk down to about half a normal. We'll position size for about, because it's a directional move, don't want to have a strong position, too strong of a position size. But then you can see, the rally up to 62. There's a lot of, there's a pretty decent opportunity here to the upside for it to, and it's within 1 standard deviation. So there's a pretty easy move that it can make if it were to get away from the point of control in the value area and get into this path of least resistance that the standard deviation suggests, the volatility suggests that we can do. All right, well, that wraps us up for today. As you've heard from me, now I want to hear from you. Use that link popping out in the top right corner of your screen and open up any new threads with any comments or questions you have. All of our free subscribers have access to our Market Outlook forum. So open up any new threads, reply to anybody else's threads, and let's keep this conversation going. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon on the YouTube down below, as well as on Twitter and on Facebook, and comment on our video. Follow us on Twitter for more content between the videos, and join our website at marketscholars.com for free, as I showed you before, as well as our Facebook group that we've created for Market Outlook viewers. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.